The problem I have with a lot of technical analysis is that they have all worked at least once because they wouldn't exist otherwise, right? But it doesn't mean that you should use them all.
No.
And that's a key point. And people tend to use them all at the same time.
One of my favorite things to look at is if a stock has traded down from its 52-week high and started going towards it, because what you tend to find is that there's going to be a big pop there. Did you ever receive my my call about 15, 16 years ago? Where,
Probably not. I would have quit, I would imagine.
where it was a Saturday and I asked why the market wasn't moving in FX.
And now this guy's got a podcast. Have you ever wondered how the pros beat the market? Find the volatility and get the best trades in.
We're going to run through the top 3 tips that we can provide you to trade smarter and hopefully actually extract more profit from the market.
And yes, we're going to use real examples, Tesla and some other key winning trades.
By the end of this episode, we're going to add so much value that you are going to come away with a treasure trove of knowledge to go and take into your own trading.
And to be honest, I wish someone had told me this 20 years ago. Let's go through a quick disclaimer. This podcast is for educational purposes only and is not intended to be financial product advice or any investment recommendation. Stay tuned for additional disclaimers at the end of the episode.
This is the Market Edge. Let's get into it.
Trade when others are scared is tip number 1. Now, we've got Tesla up here. We love Tesla on this podcast because we picked it as one of our stocks and it's doing quite well. But we've got Tesla on here. Trade when others are scared. This has obviously been a mantra that's been around for quite a long time, but give us the insights.
So trade when others are scared is effectively something called, or a component of risk premium. So you're taking on risk when others are fearful to do so. And so you're more likely to be compensated for taking on that risk. Now, the interesting thing with Tesla was back in Q1, their net income, it's basically profit in a roundabout way, let's not get too complex about it, came out at $399 million, not billion, million dollars for the quarter.
Yeah.
Now, that was firstly a big miss, but pretty much I think their lowest in a good few years.
I mean, it's nothing.
It's
right?
nothing to
It's
Tesla.
nothing in terms of these big companies.
And naturally, it was related to, so many people. Firstly, having bought so many Teslas the previous years, but also Musk getting involved with government. You had loads of liberals who went insane and just said, I'm not buying Tesla anymore. But you have to think to yourself, okay, is that likely to continue over the next 2, 3, 4 years? So while everyone was selling into that figure, that $399 million figure, that's a perfect example of saying, hang on, let me just think about this and not just look at the chart. Do I actually think that Tesla is going to make more money next quarter or in a year?
And this is one of these key things, right? Because you can go, you look, and you can look at all of the earnings numbers over however many periods of time and see the billions of dollars that Tesla make. Look at the share price and see what it's done. And then what we tend to be as traders is very sensationalist, right? So you get the headline from Elon Musk and you get that fear that comes in, right? Because everybody's panicking. And then you all of a sudden think, well, that's it, it's done, that's finished, it's gone, exploded, Tesla's dead, Musk is dead, and then we're all in trouble.
Yeah.
And sell.
Yeah, but then if you look at the chart, you can see where that Q1 number came in.
Yeah.
So basically, what was it? April they would have done their quarterly call.
Yeah.
And then you can see that was basically the bottom. Why? Because things can't get worse, basically. So while, let's call it dumb money or uninformed traders are selling into that, that risk premium steps in where people are saying, hang on, I can be compensated for getting involved here. And I always have like a little red line under that bottom to remind myself that is where the Tesla net income bottom is. So it's a really good sort of story point,
Yeah, and you get this. I mean, we often talk about this, don't we? This thing of, and actually, I was talking to someone the other day, and this shows you, retail training. I took my kids to football training yesterday, and one of the dads just walked up to me and was talking about trading. Oh, I've been trading this, I've been trading that, and he was saying, oh yeah, what I try and do is literally, he literally said this. He said, what I try and do is just pick the tops of some of the big stocks, and I was like, right. I was like, how's that going? He went, yeah, not that well for now. And I was like, yeah, well, of course, probably, and not mean to be big-headed about this, but fundamentally, that's the complete most ridiculous thing I've ever heard.
Yeah.
And there's this whole feeling of, when things go wrong, you just have to sell the life out of it, right? And that whole panic thing, we always look for volatility, right? And you look at the VIX. VIX is another word for the VIX is the fear index, right? So you get the situation when markets become more volatile, that they become more volatile. There's more traders in there, which means it's not the stupid traders who are in there making bad, wrong-informed decisions, giving you opportunities like this in Tesla.
Yeah, there's an interesting thing you can say to people if things are going wrong all the time or most of the time. How many expletives
are in it?
No. You can just say, well, have you tried doing the opposite? Because clearly if something's not working, probably the other thing's going to work. But people have this thing about buying...
Have you tried buying stocks that are going up?
Well, yeah, exactly. But people have this thing about buying, 52-week highs. And yet one of my favorite things to look at is if a stock has traded down from its 52-week high and started going towards it. Because what you tend to find is that there's going to be a big pop there.
Yeah.
Whereas most people kind of want to say, I'm going to take some profit here, and it's like, it doesn't make sense to me. I want to size up there.
Maybe it's not necessarily by the dip, but we're looking at 52-week highs, which is really simple, right? Looking at 52, it's just things that have been going up, and it's a complicated way of saying things that have hit new highs in the last year, obviously, right? And buying the dips and it doesn't necessarily matter, because the fundamental viewpoint of this is that it's going to keep going up, and the only reason you buy the dips is to make your entry price that little bit lower, right? But actually, okay, it does matter, but fundamentally, your long-term view is this is going up anyway. So if you're buying the dips, you're just trying to get a better entry level into it. So it doesn't mean anything for your overall portfolio or your overall idea of where the trade's going, because the idea that the trade is just going to go up. You try and buy the dips just to give you a little bit better entry level.
Yeah, it's definitely a way to work things. I mean, I focus purely on momentum, so buying the dip isn't necessarily something that I would do, because I tend to wait for the market
and dips tend to be when momentum dies off.
Exactly. And so that's one thing that I'm always cautious of in a world where momentum has been the largest annualized factor of performance over the last 30 years. Buying the dip is great. However, I like to just make my life easy.
Yeah, and plus, if you are buying the dip and you're buying when there's low momentum, it just means you're waiting longer for that to go up again.
Yeah, to an extent.
Not saying it won't, just saying you may wait a bit longer.
But for me, price is irrelevant. Price doesn't really matter at all. I'm looking at, okay, well, what are the signal or factors suggesting to me? A dip is not a factor that I really look at, unless there's very specific cases like Intel, whereby we know that the Trump admin is in. The market's dipped. He wants to save all American big conglomerates, and so he takes an equity stake in Intel. That was probably one of my favorite ideas in terms of buying a dip. But even then, I wasn't buying a dip. I was buying the range.
The news story of what was going on as well.
Yeah, so. I was buying the range, and then focusing on the momentum after that.
Yeah. It was interesting actually, because I was at this. Been at a few things recently. I was at a prop show the other week, and they were talking about. There was this big seminar, and it was around buying zones and selling zones, right? Now, this wasn't about buying zones and selling zones. This was just another way to trade support and resistance, because they just repackaged the word support and resistance as buying zones and selling zones.
Yeah.
You get a lot of that these days.
On this point, there is a lot of the love towards repackaging very simple concepts that have actually never really worked anyway. And dressing it up in lovely language, there's guys called ICT and SMC and all of this smart money concepts, pretending that they know how, an institutional FX dealer trades, which is actually just a bloke from Essex who's just making two-way prices.
Nothing wrong with blokes from Essex, mate.
Absolutely nothing wrong with them. They're very, very good at what they do. What's that?
Some of them.
Well, some of them, yeah. But there's nothing really complex going on. You can talk maybe about quants and low latency stuff. That is buy-side institutional. But this kind of market maker, it's just nonsense.
But there's a fundamental shift towards this. Actually, we're going a bit off topic, but there is a fundamental shift towards overcomplicating things that don't need to be complicated. Throwing an acronym in on a brand new acronym in on something to make whoever is on social media look intelligent and look like they know what they're talking about. Yeah. And the amount of times recently I've been interviewing someone or doing something, and people will say an acronym, and I'll go, "Oh, sorry, what does that mean?" And they're like, "We've got cut because I actually don't know what that means." And it's madness. They're just spitting this stuff out.
Who are you interviewing?
Yeah, right. If they pay, it's fine. It doesn't matter what they do. Anyway, let's swiftly move on to tip 2. Tip 2, so broken company versus out of form stock. And the chart we've got here is Nike.
I'm actually a fan of Nike.
Yeah?
I think they're going to...
This is obviously not on by the 52-week highs idea.
No, I'm a fan of Nike, and there is the potential for momentum to come into the market, I think, but it's not there yet. But talking about that kind of line in the sand thing, they changed their CEO.
Yeah.
They've gone back to, and I mentioned it last year, the marketing.
This is what you mean in terms of broken company?
Yes.
So versus something, so whether the company's fundamentally screwed or actually the stock is just not in vogue, if you like.
Well, Nike has been fundamentally screwed, but this is where I'm thinking that now that they've changed their marketing back to elite. Yeah, they've changed the CEO away from management.
We touched on this a few weeks ago, didn't we?
We changed the CEO away from a management consultant to someone who has, a bit more vision.
Yeah.
And they've also re-siloed their teams into very specific components.
Yeah.
That's a story to me that can indicate a bigger sort of discretionary change.
Well, it shows a big shift, especially when you look at that. I remember the move to elite we were speaking about after the Open when Scotty Scheffler won the Open.
Yeah.
Right? Because it had previously been, for however many years running up to that, it had all have been about normal people wearing Nike and doing amazing things and whatever. But you see, historically, what Nike went for from a marketing perspective was Michael Jordan, elite, elite sportsman. And this move back to Scotty Scheffler being an elite sportsman is a key one. People buy aspiration, right?
Absolutely. But I think, it has to be coupled with the right signals as well, if you like. I know that's a very dirty word, but I use more quant-based signals in what I do. And so just because the narrative's there doesn't mean the market's going to start shifting.
Nike's been broken or out of form for a while. They've fallen behind, likes of Adidas and things like that. But they're still fundamentally one of the most recognizable brands in the world. Whereas I suppose if we're looking at other broken companies, you look at companies that completely failed. The likes of Blockbuster, who were big brand names that failed and they just couldn't carry on, right? And the likes of Woolworths and things along those lines. But big brands do fail, fundamentally. Not that Nike's going to be one of those that fail, but a big brand can fail.
Yeah, I think in terms of, calling them broken, I'd like to say they definitely were broken because they moved away from their traditional, marketing, customer base, that kind of thing. But then that can shift. Now, if they continued along that broken, path, they could have gone absolutely to crap, if you like. Now, the difference, I think, between Blockbuster and Nike is that, yes, people are always going to want clothes, but not everyone's going to want to rent DVDs and games.
Yeah. So we've got another example here, right, of with AIG.
Yeah. So I guess this is just purely, a COVID play.
Yeah.
It completely fell off when airlines stopped being airlines over the lockdown.
Yeah.
And then obviously the natural story was once you're allowed to do air travel again, the airline's going to recover. So out of form based off of something that we know is something that is going to come back. Now, what kind of chance would you apply to COVID then just being completely long lasting and then never ever being air travel again? Probably zero, right? So when you start to see the momentum to the downside die off, it's probably a good time to buy something like that. But these events rarely happen, that's a black swan 10 sigma event. Like, it's just insane.
Yeah, but these things, but this is the point, some of these things do come back. But you can tell, air travel is going to come back, whereas renting VHSs isn't going to come back, right?
Exactly.
The internet moves on. Look at the way Netflix used to be Love Film, right? Love Film used to post you out DVDs, but then the whole company shift online, and then you have an online platform, and then that's Netflix is Netflix, right?
Same price, and now you can watch tens of thousands of things.
Yeah.
That's insane.
Yeah, exactly. So Oh, did you used to like going to Blockbuster?
I loved it.
Pizza Hut and Blockbuster.
Friday night, spending half an hour looking for what game I was going to play on PlayStation 1 or 2.
Yeah, me and my wife standing there looking for a video to rent.
Yeah, I remember my parents renting the Limey.
Limey?
Yeah, that's how many years ago.
That is a throwback. This is tip number 3, and I think this one is one that will resonate with a lot of people because the tip 3 is keep it simple. Now, back years ago when I first started working in trading, I worked on the help desk, right? Just receiving calls from people.
Did you ever receive my my call about 15, 16 years ago? Where,
probably not. I would have quit, I would imagine.
Where it was a Saturday and I asked why the market wasn't moving in FX.
And now this guy's got a podcast.
To be fair, I was 17 then, so.
Why the market? Yeah.
I don't know.
Did you also wonder why no one picked up the phone on a Saturday?
Well, no, actually, to be fair, I'd messaged it on Twitter at the time.
Yeah. But obviously, keeping it simple. So, working on the help desk back then, we used to get people, and I had a background in trading, right? So it was all about I could help people out with their trades, not giving them advice, but people used to send me charts, right? And it's like they'd eaten. Do you remember there's a technical analysis Bible, like John Murphy Bible on technical analysis. Like people had swallowed that and then spat every line out onto a chart that they possibly could. And then would say, forward it onto us and say, oh, can you ever look at this chart and see, where I'm going wrong? And the key point within that is you couldn't even see the price. The price wasn't even on there. Now, this tip is obviously about keeping things like that simple. You do not need every piece of analysis, especially charting, that you can find on a chart.
Yeah.
Now, the problem I have with a lot of technical analysis is that a piece of technical analysis, whether it be, I don't know, Ichimoku charts, an RSI, whatever it is, they have all worked at least once because they wouldn't exist otherwise, right? But it doesn't mean that you should use them all.
No.
And that's a key point. And people tend to use them all at the same time.
Yeah, well, fundamentally, I think you have to understand the asset that you're investing or trading in.
Yeah.
In this case, we're looking at Nvidia.
And actually, technical analysis would go completely away from that. Because a lot of technical analysis will say it doesn't matter what you're trading on because charts all perform the same.
It's complete nonsense.
I totally agree with you.
You can't compare, FX, which is inherently mean reverting, to something like Nvidia, which is a momentum factor trade. I mean, that's like saying, oh yeah, I'm going to compare one specific part of the yen carry trade when that was happening, when there was sheer momentum, to Nvidia.
Yeah.
It just doesn't make sense. But on an intraday basis, it's even completely different. So you can't model the same things out.
Yeah.
So moving averages, for me, are a good way to determine trend, when's optimal to get in and when's optimal to scale back. And like if market drops through some moving averages once you've been long, you can take some off at each point, while also maintaining a strategy to get back in for upside if it starts going and trending back above. But I think as well, time frame matters a lot. A lot of people are trying to do very, very short time frame stuff, and it just doesn't make sense anymore.
So where do you stand on multiple time frame analysis?
You don't need it, really. I mean, for me...
Again, I was at this show a few weeks ago, and there was, again, someone else that's saying multiple time frame analysis is key to trading.
No. I think, daily, weekly, and monthly is what I look at.
Yeah.
And that's it.
Yeah.
I don't really dip below that unless I'm maybe having a punt around in futures or something like that.
Yeah.
But for stocks, why do I care about it? So the other interesting thing is actually that most trading in stocks happens in the 30 minutes after open and 30 minutes before close, even more on close these days.
Yeah.
Everything in between is largely a lot of noise. So what I tend to focus on is what is the signal at the close of the day suggesting to me, if it's like a momentum signal, for instance. Even more importantly is what is the very last 30 minutes of the week suggesting to me. And so I'll use...
that's positioning into the weekend, isn't it?
Exactly. I'll use the weekly close then as an additional signal as to, maybe I want to actually finally action a stock I've been looking at for a month.
And I suppose the key thing about positioning into the weekend is what you're doing is you're protecting your portfolio. Now, and you won't just position yourself, you'll do this on every position you've got, right, with BFX or whatever, but you're positioning yourself because you don't know what happens from Friday when markets close to an open on Sunday or Monday morning, whatever it is that you're trading. So you want to position yourself over that time frame for the least amount of risk to hit your portfolio.
Yeah, I mean, for me in stocks, it's not leveraged.
Yeah.
I couldn't give a monkey's what happens over 2-3 days. If the stock goes down 10%, I'm not bothered. My risk will just kick in on the next week. But I'm not looking short term here. I'm not looking even intra-month or even intra-quarter most of the time. I'm looking minimum probably 6 months.
Yeah.
Hopefully, if a view is strong enough, minimum a year.
But a lot of people are trading short term, right? And I think we can't get away from that. A lot of people are trading short term. They are trading stocks, and they are trading. A lot of people are trading stocks and being in and out over the space of a week, a couple of days. They're trading FX or crypto or whatever it may be, and there are continuous market, of course. But from a FX perspective, there are inherent risks that happen out over the weekend.
Absolutely. So, and my way is not the highway.
Yeah. Well, there's all different sorts of trading.
I just got a 5-year-old and I can't be bothered to do stuff all day, every day.
Yeah, but again, this is life, right? People have jobs, day trade.
Exactly.
Because I think there's always been a bit of a I can't think of the word I'm thinking of, but there's always been a bit of a mentality within trading, retail trading, that to do retail trading, you have to be a day trader. You know, you have to be banging around the markets. But reality is, okay, people have got more time these days because they're not in offices all the time or whatever. But, you know, away from that, there's people do other things. You've got jobs, whatever. You know, you don't have to be in the market all the time to be a successful trader. You don't have to go in and bounce around the, dollar Turk all afternoon.
No, I've done 78% on my SIP over the last 18 months with 12 investments, and the last change that I made was June.
Yeah.
And I don't have much turnover at all. The only turnover now that I have is whether I'm adjusting my risk.
And I actually think the number one, I mean, so many mistakes that people make when they trade, like we've done, like you've done. We've all made mistakes when we've traded. But I think the biggest one is people force themselves into a trade because they think they have to be in a trade. And that is fundamentally the number one mistake that people make. People lose money because they open an account. And this, the life of a retail client is this. You come in, you marketing stuff from a company, you see it, you're excited by it, you want to trade. You open an account, you put your money in, you trade. You go up this mountain, and then you lose money. And you never really climb back up there.
No.
And that's why so many brokers in this situation do the same thing. They lose clients. And there's always been this misconception that a retail broker wants to take your money in order for them to make money. It's not always, it can be the case, but it's not always the case anymore. It costs too much money for a broker to get new clients. So they want to keep clients. So the last thing they want is you coming in, climbing this wall of excitement to get into trading for them to lose it all, which is why education and everything is so key.
Yeah, there's various ways brokers can monetize clients these days.
Yeah, exactly.
There's various ways.
So there you have it. We've got 3 key tips there, and hopefully they're going to work. But let us know what you think. Comment. Let us know if we're right. Let us know if you've done any of these. Let us know if you've got any other tips, and that'll help out anyone else who's watching. Like and subscribe, and we'll see you next time. This podcast is for educational purposes only and is not intended to be financial, product advice, or any investment recommendation. It has been prepared without taking your objectives, financial situation, and needs into account. Any references to past performance and forecasts are not reliable indicators of future results. For more information, visit axi.com.